The fair value gap is one of the most powerful concepts in trading. It's a strategy that has led me to numerous successful trades over the years. However, many traders tend to misuse it, leading to losses instead of gains. The biggest challenge in trading with fair value gaps is identifying which ones are most likely to succeed. Not all gaps are created equal. Some have a higher potential for profitability than others. In this video, I'll share the insider tips you need to know to spot the most effective fair value gaps. And as a bonus, I'll walk you through the top 3 trading strategies that have helped me consistently profit using these gaps. Let's dive right in. A fair value gap occurs when price action moves sharply in one direction, creating a gap between candles on the chart. Often, the price will retrace back to this gap, like a magnet, as it seeks to fill or retest the area. Traders can use this opportunity to enter positions when the price approaches the gap, aiming to catch the bounce and profit from the move. To plot a fair value gap, you'll need to identify a sequence of 3 candles. Look for a large middle candle between 2 smaller ones, where the high of the first candle and the low of the third candle don't overlap. The space between the high of the first and the low of the third candle is your fair value gap. Now that you know how to identify and draw fair value gaps, it's crucial to understand that some are more likely to yield profitable trades than others. Here are 5 techniques I use to pinpoint the most promising gaps. Look for unmitigated gaps. For a fair value gap to have high potential, it must remain untested by price action. In other words, if the price has already retested the gap, it loses effectiveness. The best fair value gaps are those that haven't been touched yet, and when price retraces for the first time, you want to ensure it doesn't break below the gap. Prioritize larger gaps. Larger fair value gaps are typically more reliable. They indicate a stronger imbalance between buyers and sellers, making them more likely to act as solid support or resistance zones. When comparing gaps, always prioritize those with greater size. Use Fibonacci retracement to filter gaps. When you encounter multiple fair value gaps in a setup, focus on those forming around the 61.8% Fibonacci level or the 50% level, which is closely watched by many smart money traders. These levels often act as strong areas of support or resistance. To apply this method, use the Fibonacci retracement tool on charting platforms like TradingView. Draw the retracement from the swing high to the swing low, or vice versa for bullish setups, and concentrate on the fair value gaps that align with or are near the 61.8% or 50% levels. These gaps tend to have a higher probability of success due to the confluence of technical factors. Avoid gaps near key levels. If a fair value gap forms as the price nears a significant key level, it's best to avoid it. These key levels, such as major support or resistance areas, can cause the price to reverse, rendering the fair value gap ineffective. Favor gaps after a break of structure. Fair value gaps that form immediately after a break of structure are gold. These setups tend to have some of the highest win rates. A break of structure occurs when price in an uptrend breaks a previous high or in a downtrend breaks a previous low. When a fair value gap forms after such a break, it becomes a prime setup for retracement and a bounce. To trade effectively using ICT fair value gaps, follow these steps. Step 1. Determine the market trend. The first thing you need to do is identify whether the market is trending bullish or bearish. This can be done by analyzing the overall direction of the asset. In an uptrend, the market will form higher highs and higher lows, while in a downtrend, it will create lower lows and lower highs. Step 2. Identify a large candle. Once the trend is determined, your next task is to locate a large candle with a significant body and minimal wicks. In a bullish market, look for a strong bullish candle with a wide body. Conversely, in a bearish market, focus on a large bearish candle that also has most of its range in the body. Step 3. Analyze the surrounding candles. After spotting the large candle, examine the candle just before and the one right after it. Both the preceding and following candles should not overlap the body of the middle candle, which helps confirm a fair value gap. This gap is formed between the wicks of the first and third candles. Step 4. Mark the fair value gap. In a bullish setup, the fair value gap is the space between the high of the first candle and the low of the third candle. For a bearish setup, the fair value gap forms between the low of the first candle and the high of the third candle. Once identified, Mark this zone on your chart as the potential area for price retracement. Step 5. Execute the trade. If the market is in a bullish trend, wait for the price to retrace and test the fair value gap to rebalance the market. Once the price reaches this gap, look for additional confirmations. For example, when the market retests the fair value gap and shows a clear rejection, you can enter a buy trade at the close of the rejecting candle. Set your stop loss just below the fair value gap zone and aim for the next significant price level as your take profit target. For a bearish version, the steps are similar but reversed. If the market is trending downward, you wait for the price to pull back to the fair value gap after forming lower lows and lower highs. Once the price tests the gap and is rejected, you enter a short position, placing your stop loss just above the gap and targeting the next lower price level for profit. Now that you've learned how to trade the fair value gap, as it's known among smart money traders, here are 3 strategies that I use to boost my profitability using fair value gaps. The inversion gap strategy. An inversion gap occurs when price is broken through a fair value gap, but that same gap can still act as a reversal level on its next retest. In this scenario, you take a position in the opposite direction of the original gap once the price retraces to it. This strategy works best on its first retest, so be cautious if the price crosses through the gap multiple times. As you can see, the market initially formed a bullish fair value gap when the price surged upwards. After this initial move, the price broke through the gap. Following this break, the price retraced back to test the fair value gap, which now acted as a resistance level. At the point of contact, the price rejected the gap, indicating a potential reversal. A short position was taken at the close of the rejecting candle, with the stop loss placed just above the fair value gap zone. The profit target was set at the next significant support level, which the price reached, resulting in a successful and profitable trade. Look at another chart example here. The market initially formed a bearish fair value gap when the price dropped significantly, leaving a gap between the candles. After this initial downward move, the price broke through the fair value gap and continued lower. However, when the market retraced back upwards, it returned to test the same fair value gap, which now acted as a support zone. Upon touching the gap, the price rejected it, showing signs of reversal. A long position was entered as soon as the rejection candle closed above the gap, confirming the reversal. The stop loss was placed just below the fair value gap zone, ensuring risk management, while the take profit target was set at the next key resistance level. As the price rallied, the trade ended with a profitable outcome. Fibonacci confluence strategy. This strategy combines fair value gaps with the Fibonacci retracement tool to create a powerful trading setup. The key is to focus on fair value gaps that align with the 61.8% Fibonacci level, often referred to as the golden zone, or the 50% level, which both serve as strong areas of support or resistance. To execute this strategy, mark the fair value gaps on your chart. Apply the Fibonacci retracement tool and prioritize the gaps closest to the 61.8% or 50% levels for your entries. Let's look at a real chart example where the market is in an uptrend. The price makes higher highs and higher lows, forming a bullish fair value gap. After this move, apply the Fibonacci retracement tool from the swing low to the swing high. You'll notice that one of the fair value gaps aligns with the 61.8% Fibonacci level. In this case, the price retraced back to this golden zone, where the fair value gap also lies. The market tested this level and showed clear rejection, confirming it as a support zone. A long position was then taken at the close of the rejection candle, with the stop loss placed below the fair value gap zone and the 61.8% Fibonacci level for added security. The take profit target was set at the next resistance level, and the trade turned out to be profitable as the price bounced off this confluence area. Now let's consider the opposite scenario. The market is in a downtrend, forming lower lows and lower highs. A bearish fair value gap appeared as the price dropped sharply. This time we apply the Fibonacci retracement tool from the swing high to the swing low. The 61.8% Fibonacci level lines up with a fair value gap. As the price retraces upward to the golden zone, it tests the fair value gap, which now acts as resistance. The price rejects this level, confirming the confluence. A short position was entered after the rejection candle closed below the fair value gap. The stop loss was set above the fair value gap and the 61.8% Fibonacci level, and the take profit target aimed for the next support level. The trade ended successfully as the price reversed from the confluence zone and moved downward. Fair value gap and order block strategy. This strategy combines the power of fair value gaps with the concept of order blocks, another important element in smart money trading. An order block represents a specific zone where institutional traders have entered significant positions, either buying or selling. When combined with fair value gaps, this can create highly reliable trade setups. How it works. The key is to identify an order block that aligns with or is close to a fair value gap. When the price retraces to this zone, you have a stronger confluence for a potential trade entry. In a bullish trend, the price makes a strong upward move, leaving behind a bullish fair value gap and an order block near the same level. The price then retraces back towards this area. Once the price enters the fair value gap and tests the order block, it shows signs of rejection, confirming strong institutional buying interest. In this case, a long position is entered after the rejection candle closes. The stop loss is placed below the order block, while the take profit target is set at the next resistance level. The trade is successful as the price moves higher from the confluence zone of the fair value gap and the order block. In a downtrend, the price drops sharply, forming a bearish fair value gap and leaving an order block in the vicinity. The price retraces upwards, approaching the fair value gap and the order block. Upon reaching this area, the price rejects it, confirming strong selling interest from institutional traders. Here, a short position is entered once the rejection candle closes below the order block. The stop loss is placed above the order block, and the take profit target is set at the next support level. As the price drops from this confluence zone, the trade results in a profit. And there you have it, everything you need to know about trading with fair value gaps, plus some advanced strategies to help you take your trading to the next level. If you found this video useful, don't forget to smash that like button and subscribe for more content like this. Your support helps grow the channel, and it means a lot. If you have any questions or want more clarification on any of the strategies, drop a comment below and I'll get back to you. Thanks for watching, and I'll see you in the next one.